Hi everyone, and welcome to today's re-recording of my presentation given at the 2011 Traders Expo in Las Vegas. My name is Tim Racette, and it's my pleasure to be speaking with you. In today's presentation, you will learn about the 10 costliest mistakes a trader can make, and I promise you will take away some valuable techniques for avoiding them. 90% of all those who try their hand at trading fail within the first 3 months. Of those who make it past the first 3 months, 90% fail in the next 3 months. And by the end of 1 year, fewer than 10% remain. The goal of this talk is to give you a specific action plan to avoid 10 costly trading mistakes. I'll provide steps to ensure you don't fall victim to these mistakes and hope that you may one day join the top ranks of elite traders. Over the past 6 years, I have made a number of my own trading mistakes. I've documented these mistakes and compared notes with other top traders, seeking out best practices. I've condensed this knowledge into today's presentation titled How to Avoid 10 of the Costliest Trading Mistakes. A little bit about me. I'm a full-time options and futures trader, born and raised in the Chicagoland area. I'm also an Arizona State Sun Devil, and it was in Arizona that I discovered one of my other passions, mountain biking. I really enjoy traveling and had the good fortune to spend some time in Costa Rica last spring. If you've never been, I would certainly recommend it. You can read more about me, my trading, and my travels at my blog, emoneymind.com. My presentation today is comprised of 10 slides. Each covers one of the 10 costliest mistakes I feel you can make as a trader. Having missed more than 9,000 shots in his career, lost almost 300 games, and on 26 occasions was entrusted to take the game-winning shot and missed, Michael Jordan says, "I have failed over and over and over again in my life, and that is why I succeed." What does the path to success look like? It starts with learning. How do you yourself learn best? Are you an auditory learner? Do you learn by watching? Or do you learn by doing? For most of us, the path to success comes in the form of making mistakes. In trading, mistakes equal losses, painful drawdowns to your account, the feelings of defeat and failure. Inherently, it's not until we feel this emotional pain that we learn our lessons. At this point in trading, it can often be too late. So I ask you over the course of today's presentation to take a step back and take an honest look at your trading to determine which mistakes you identify with. In doing so, you'll be better equipped to move to the next step, which would be avoiding them. So let's jump right in. The first mistake common to most traders is impulse trading. Maybe you've heard the saying, luck favors the prepared. If you've ever found yourself entering a trade impulsively, you know that these trades usually result in a loss. The main error here is that you are unclear of the exact setup which you are looking for. These are typically a reactionary response. You want to take the time to plan out and develop criteria for entering and exiting your trades, as this will equip you with patience when it comes time to pull the trigger. Impulse trades are usually triggered on emotion. And human emotions are incredibly powerful. We're all striving to behave like traders, and it's our attitudes which influence our behavior. Our emotions have a strong influence upon our attitude, therefore we must learn not to eliminate our emotions, but rather not to act on them. It's really important to know your setups. Part of my nightly homework routine is to go through the day's price action and review all the setups for the day. This is a great way to build confidence and trust in your edge. I review all of the trade setups I took and consider it a successful day if I followed all of my rules. One exercise you can do is to grade your trades. And this exercise I suggest because it does help avoid these impulse trades. So for trades where you followed your rules perfectly, regardless of the P&L outcome, give the trade an A. If you broke any rule at all, give it a C. And if you entered on impulse, give it an F. At the end of the day or week, go back and see which trades were net profitable. You'll find that over time, it's the A's, the trades where you followed your rules perfectly, that produce the net profits, while the C's and F's result in losses. And finally, break your rules and you will fail. The only guarantee in the markets is this: if you break your rules, you will fail. So challenge yourself to be disciplined 100% of the time, all of the time. The second costly mistake is not using loss limits. Traders who do not use loss limits are one bad trade away from a catastrophic failure. I define my risk per trade well in advance, risking no more than 1% of my total trading capital per any one trade. Set daily and weekly limits. You can set hard daily and weekly loss limits with your broker to prevent a devastating account blowup. I recommend limiting yourself to a maximum 5% drawdown in the day, and a weekly loss limit should be no more than 10%. If you're regularly seeing these loss limits get hit, it's time to go back to the drawing board and find out where the issues are. A trading journal like Stock Ticker is a great way to fine-tune your trading edge, and is the journal that I use for recording and analyzing all of my own trades. Look to eliminate the big loser. There are really only 4 possible outcomes to any trade: a big winner, a small loser, and a big loser. By eliminating the big loser, you have dramatically increased your odds for profitability. You can do this by defining your risk before you place the trade and risking no more than 1% of your trading capital. After going back through my trades, I found that I never had a winning day when I took more than 2 full stop-outs. For this reason, I limit myself to 2 full stop-outs on the day. This protects me from continuing to trade when the market is clearly not producing an environment conducive to my trade setups. Now, I do use a smaller price target for my trades, and at that point I will tighten my stop. So these 2 full stop-out limits are limiting myself to 2 full stops on the day. And using loss limits allows us to live to trade another day. The one time you decide to break these rules will be the time that the devastating drawdown occurs. We put these measures in place so we can live to trade another day. It is when we are at our weakest that we need these loss limits the most. Number 3 is trading too big. You need to understand risk capital, and obviously no one likes to lose money, but your trading account should be funded with money that, if lost, won't affect your current lifestyle or extend your retirement. Don't trade with money you can't afford to lose. I'd like to read a short excerpt from author Jack Schwager in his book Market Wizards. Mr. Schwager says, "If your trading capital is too important, you will be doomed to a number of fatal errors. You will miss out on some of the best trading opportunities because these are often the most risky. You will jump out of perfectly good positions prematurely on the first sign of adverse price movement, only to then see the market go in the anticipated direction. You will be too quick to take the first bit of profit because of concern that the market will take it away from you. Ironically, over-concern about losing may even lead to staying with losing trades, as fear triggers indecisiveness, much like a deer frozen in the glare of a car's headlights. In short, trading with scared money will lead to a host of negative emotions that will cloud decision-making and virtually guarantee failure." I thought that was a very applicable quote, and there's a lot of nuggets of wisdom in that quote alone. Again, that's from Jack D. Schwager in his book Market Wizards. Think risk first, then reward. You want to measure the risks, and if you can accept them, move forward with the trade. Once you've defined your risks, the profits will then make themselves available. If you define your risk from the start, you know that each day going in, your maximum loss is defined, while the upside potential is infinite, potentially. Earn your way to trade larger. There is no faster way to fail as a trader than increasing your contract size just because you think the trade is going to be a home run. In doing so, one loss can eat away at weeks, if not months, of profits and sometimes end the trader's career. You want to define your risk and always use stops. Don't rely on trading to pay the bills. Now, this is really important. The psychological stress that is generated from relying on your trading to pay the bills, at least at first, can cause you to force trades and fail as a trader. I find it's really important to integrate trading into your current lifestyle and slowly make the transition to trading full-time, if that's your goal. I recommend having a year's worth of living expenses in the bank to be able to make the leap to going full-time, so that you're not relying entirely on your trading account, which, like I said, can help or can inhibit you from trading well and objectively. So this helps focus. This helps you focus and keep your mind thinking clearly and objectively by having your expenses covered. Number 4 is influence by others, and this is incredibly important. You need to know that no one can predict the market. I like to keep my opinions to myself, and engaging in discussion about your opinions of the markets can really lead you to change your thesis and may prevent you from putting on that winning position. Oftentimes when we're discussing markets with different people, we may not be clear, it may not be clear whether they are long-term, short-term, intraday, swing trading. So if you're talking to someone about their views in the market, I may be bullish today, but in the long run, trader B that I might be having a conversation with might be bearish. So you really need to understand the time frame that you're discussing, which is why I just like to keep my opinions to myself. Know that you are in control. You are in complete control of your success or failure as a trader. You must hold yourself accountable for all trading decisions. If you have formulated an opinion about the markets, hold it loosely. Make sure to have a plan B, a backup plan. What will I do if the market doesn't act as I anticipate? And remember that anything can happen. Trade in the now with the information in front of you. The next mistake that most traders make is a lack of planning. And you've probably heard the saying before, treat trading as a business, not a hobby. It's an important one, because hobbies cost money and businesses make money. So take your trading seriously. A lack of planning is an extremely costly mistake. Preparation and routine are key. The markets are wild, we all know this. Our routine creates structure around the spontaneity, which is the market. When a lawyer gets assigned a new case, the first thing they will often do is prepare the arguments for the opposing side. This helps identify any gaps and questions that could arise. I find it's always best to over-prepare. Use discipline 100% of the time, all of the time. Each time you let your guard down, make a mistake, or break your rules, money is lost. There really is no room for mistakes in this game. You must force yourself to be disciplined at all times. Write it down. Writing out your trade setups and goals will help bring clarity to your ideas. I do this process repeatedly, which is one of the reasons for starting the E-Money Mind blog. I find that writing forces me to think through my ideas in depth and dig down to the core idea. And know that there's no shortcuts. Malcolm Gladwell, in his book Outliers, talks about the 10,000 hour rule. And he says that it takes 10,000 hours to fully master a cognitively complex subject. Put in the time both during and after market hours, studying, reviewing charts, and more importantly, learning about yourself to better understand human behavior. Too many indicators. This is an extremely costly mistake, and it can often lead to analysis paralysis. I'm sure we've all suffered from this one, having too many indicators forcing you into a state of analysis paralysis. I challenge you to go through and simplify your trading screen. Remove any indicator or chart that does not directly relate to your trading plan. This will help remove the noise and conflicting signals when it comes time to pull the trigger. Less is more. There are 1,000,001 ways to skin a cat, and there are many ways to trade successfully. Sometimes the less information you have on your screen, the better you will trade. Define your core setups. As we just discussed with writing down your setups and goals, define those core setups that work well and give you that edge. Focus on executing them perfectly the exact same way each and every time. This is the foundation of your trading and will be extremely important for your growth as a trader. Next we come to revenge trading. After taking a loss, sometimes we take a loss and we feel that we want to make it right back, but it's important to wait for the next best opportunity. Oftentimes, newer traders feel the need to make back that loss immediately on the same instrument that took it from them. You must force yourself to remain patient and wait for that next valid setup. Remember that each trade is individual to itself. Don't let the outcome of a prior trade influence the next trade. This is very difficult for a new trader who, after taking a loss, wants to make it back and get revenge. Just because your last 3 trades were losers, you may decide not to take the 4th, which in turn was the big winner that made up for the 3 losses. So reviewing your trades each night, reviewing your trade setups, and knowing exactly what you're looking for will help overcome this mistake. You want to create that statistical edge, and using a trade journal, as I mentioned before, such as stock ticker, is a great way to compile your data and establish your exact edge in the markets. The discretionary trader must focus on managing each trade the same way, or the statistical edge will be skewed. One thing I like to do is think in terms of ticks and not dollars. One trick this really helped me early on, and this helps keep it more of a game rather than strictly making and losing money. And finally, the 7x7x7 breathing technique is something that can help you stay calm throughout the day. Especially after taking a stop out, try the 7x7x7 technique. What you want to do is breathe in to the count of 7. Hold your breath for the count of 7. And breathe out slowly to the count of 7. Doing this helps calm the body and brings you back to a state of clear objectivity. I also like to take walks throughout the day, and I find that breathing in deeply, doing the 7x7x7 breathing technique, and getting outside, putting myself in green environments does help keep me calm and thinking clearly. Number 8 is taking profit too early. This was a big one for me. We take profits early because we're scared of giving back what we've already made. Knowing your edge and probabilities will help to remove this fear. In reviewing your trade setups each night, go back and look at where your max profit was and see if you can find any commonalities which may lead to an ideal profit-taking point or trailing stop method. So as we just talked about, taking a profit too early is a result of being scared of losing. You want to let the system work. Don't rush it. Force yourself to remain disciplined and use patience. Place your effort into trailing your stop as opposed to dragging your profit target in. Again, review your setups each night. This was a crucial step to build confidence in my trading because going through each night and identifying my setup really helped me see that they work over and over again over a statistical set. And finally, focus on trading well. The profits will follow if you can simply eliminate those big losers. Stick to your plan and strive to detach yourself from the emotions of winning and losing money. Overtrading is the next costly mistake many traders make. Overtrading is, in a big way, led by impulse trading. In defining your core setups, you will know exactly what you are looking for, and you won't feel like every signal that you see is a trading opportunity. It's extremely important to either write out your trade setups, capture screenshots, physically say your core setups, and define your core setups in whichever way resonates with you. It's not enough just to have it in your head. You need to have it down on paper, you need to have screenshots, or you need to have it recorded in audio format. You need to be able to see your core setups in your sleep. Remember that patience pays. Sometimes there are just no setups, and that's perfectly okay. After all, it's better to be 0 on the day than down or in the red. You want to review your loss limits, and these are the loss limits that we talked about before, and you want to both set them as hard stops with your broker and review them to make sure that the amount that you're risking is comfortable for your trading and allowing you to continue to trade well. Look to find commonalities among the winning trades. Sometimes this is easier to do by looking for similarities among the losing trades and filtering out groups of those trades. Really, this is an iterative process, and you will continue to evolve as a trader as you adapt to new market conditions and continue to fine-tune your trading plan. Those loss limits stop the bleeding. As we talked about earlier, I limit myself to 2 full stop-outs on the day. And never have I had a winning day where I kept trading after I took 2 full stop-outs. This is the market's way of telling me it's not conducive to my trade setups. Stop the bleeding and come back the following day. And last but certainly not least, we come to the mistake of hesitating and chasing trades. I only use limit orders, and I recommend that you do the same. A market order is almost as catastrophic as an impulse trade. Once you've identified your setup, execute. Write down your entry criteria on a note card and keep it in front of you so you will know exactly when a setup is valid. This way you won't feel the need to chase or jump in late feeling as though you've missed the move. If you have a card or a sheet of paper in front of you, you can go through one by one and check off each criteria as it's met. And this will help reduce that feeling of hesitation and chasing. Get in and then manage. Sometimes it's best to simply get in the trade, because managing the trade is really what sets apart winning traders from losing traders. Money management techniques are key. Gaining screen time is something that you can do not only while the market's open, but while the markets are closed. One thing I used to do is print out 5-minute and 15-minute charts of the S&P after each day, and I would go through and look for different things. Look for things that were clear in the trending market, things that stood out in the range-bound market, and look for similarities among the two different types of markets. I'd go through and identify the highs and lows, look for different trend patterns, look for different candlestick patterns, and really highlight and mark up these charts. Gaining screen time is extremely important, and there's really no substitute for experience. So let's go ahead and review and give you an action plan to leave here with. Number 1 is to do your own thinking. You want to write out your entire trading plan. Set those per trade, daily, and weekly loss limits. Remember to keep your position size small. Again, I challenge you to simplify your trading screen. Try to execute each trade according to plan. Limit yourself to 2 full stop outs per day. Take walks and breathe deeply. Review your trade setups each night. And finally, commit. Put in the screen time, those 10,000 hours. Make the assertion to yourself that if being a trader is what you so strongly desire, you will do whatever it takes to succeed. Thank you for your time. I wish you the best of luck in your trading. If you do have further questions, feel free to visit me on Facebook, facebook.com/emoneymind. You can also visit me at the blog, emoneymind.com, or shoot me an email, and I'd be happy to talk more. Thanks again, and I wish you the best of luck in your trading.